Imagine two retirees beginning the exact same chapter of life. Let's call them Daniel and Victor. Both leave full-time work in the spring of 2026. Both spent decades building careful financial plans. Both worked in stable professional careers. Both followed conventional advice almost perfectly. Each accumulated approximately $900,000 before retirement. They invested in diversified index funds. They planned modest lifestyles. They calculated their annual spending needs at roughly $35,000 per year. Their portfolios ultimately experienced the same long-term market performance. Over the next 25 years, the market delivers an average annual return of about 6.5%. If averages truly determined outcomes, their financial futures should look identical. But 15 years later, Daniel is forced back into part-time work just to maintain basic expenses. Victor, meanwhile, still holds well over $1 million in invested assets and lives without financial stress. Same savings, same investments, same long-term returns, completely different outcomes. The difference was never intelligence, discipline, or effort. It was timing. More specifically, it was something most retirement projections quietly ignore: the order in which returns occur. Most financial planning tools rely on averages. You enter an expected return, press calculate, and receive a smooth upward projection that feels reassuringly predictable. But markets do not move smoothly. Real investing happens through chaos. Some years surge forward, others collapse unexpectedly. And when withdrawals begin, that randomness suddenly matters far more than the average itself. Daniel retired directly into market turbulence. During his first 3 years outside the workforce, markets declined sharply before eventually recovering. His portfolio fell early, while he simultaneously needed to withdraw income to pay for housing, healthcare, and daily living. Every withdrawal required selling investments, while prices were depressed. He wasn't making emotional mistakes. He was simply surviving. But each sale permanently removed shares that would never participate in future recoveries. Losses combined with withdrawals began reinforcing one another. This is negative compounding, and it quietly destroys portfolios. Victor experienced the exact same market environment, just in a different order. His first retirement years happened to coincide with strong market performance. Early gains expanded his investment base before downturns arrived. When volatility eventually appeared, withdrawals represented a much smaller percentage of his portfolio. The recovery worked in his favor rather than against him. Mathematically, both investors lived through identical returns. Practically, one faced early damage while the other built early resilience. This difference changes everything. Risk in retirement is not evenly distributed across time. It concentrates heavily at the beginning. The first decade after leaving work carries disproportionate danger. During working years, volatility is often beneficial. Market declines allow continued contributions to purchase assets at lower prices. Time and income act as shock absorbers. But retirement reverses the equation. You stop contributing capital. Instead, capital must support you. Market downturns now force liquidation rather than opportunity. A severe decline early in retirement creates a structural weakness that decades of future gains may never fully repair. Think of retirement as crossing a fragile bridge. The middle may be stable, the ending may be safe, but the entrance determines whether you reach the other side at all. This early period is where most financial plans quietly fail, not because savings were insufficient, but because withdrawals collided with volatility at precisely the wrong moment. The goal, therefore, is not predicting markets. Prediction is unreliable. Structure is controllable. A resilient retirement strategy separates spending needs from investment risk. One effective approach divides assets by time horizon rather than by emotion. Short-term needs remain insulated from market fluctuations. Medium-term reserves absorb extended downturns. Long-term investments remain untouched long enough to recover and compound. Imagine maintaining several years of living expenses in stable cash equivalents. If markets decline immediately after retirement, daily spending continues without selling equities. Time becomes an ally again. Beyond that layer sits a stabilizing reserve of conservative assets designed to sustain additional years if recovery takes longer than expected. Only funds intended for distant future spending remain exposed to full market risk. This structure transforms volatility from an existential threat into a temporary inconvenience. Another overlooked factor is withdrawal rigidity. Many retirees assume spending must remain constant, regardless of conditions. But flexibility dramatically improves survival probability. Small adjustments during weak market periods preserve long-term capital. Reducing discretionary expenses temporarily during downturns can extend portfolio longevity by years. Financial independence rarely fails because of one catastrophic decision. It erodes through inflexibility. Even modest supplemental income early in retirement can dramatically alter outcomes. Consulting work, seasonal employment, or passion projects generating partial income reduce pressure on investments during vulnerable years. A relatively small income stream can prevent forced selling during market declines. The psychological irony is powerful. The period people anticipate as freedom often contains the greatest financial sensitivity. After decades of preparation, outcomes may hinge on factors beyond personal control. This realization can feel unsettling, but awareness creates opportunity. The solution is not accumulating impossible wealth targets. It is understanding how risk evolves over time. Average returns describe markets. Sequences determine lives. Retirement success depends less on how markets perform overall and more on when volatility arrives relative to withdrawals. Planning for uncertainty does not eliminate risk. It redistributes it. A well-structured approach allows portfolios to endure unfavorable beginnings without permanent damage. Over long horizons, markets tend to recover. But recovery only helps investors who remain invested long enough to participate. That distinction separates endurance from collapse. Daniel and Victor followed similar paths for decades. From the outside, their retirements looked indistinguishable. Friends saw comparable lifestyles, similar homes, similar routines. But beneath the surface, invisible mathematical forces shaped entirely different trajectories. One portfolio absorbed early shocks, the other amplified them, and over time, small structural differences compounded into dramatically different realities. Retirement planning is often framed as reaching a number, but numbers alone cannot account for timing risk. True resilience comes from designing systems that survive uncertainty rather than assuming stability. Because financial freedom is not simply about accumulation, it is about durability. Markets will fluctuate, cycles will repeat. But those who prepare for unfavorable sequences give themselves something far more valuable than higher returns. They gain staying power. And in long-term investing, survival is what allows compounding to work at all. If this perspective changed how you think about retirement risk, consider how many financial outcomes are shaped not by effort, but by structure. Here on Couch Economist, we break down the hidden mechanics behind money, work, and long-term security, so decisions become intentional instead of reactive. And sometimes, understanding one invisible variable is enough to change the next 20 years. I'll see you in the next video.